Have you ever wondered if the market has feelings? I mean, really? Well, it turns out it does. And it shows those feelings not with words, but with this strange graphical pattern that we call the volatility smile. It's kind of like a secret code that reveals what the market is truly afraid of. So yeah, let's decode this thing.
So to really get what the smile is, we have to first talk about the theory it completely shattered. See, for a long time, finance had this beautiful, really elegant model that was supposed to explain exactly how options should be priced. There was just one teeny tiny problem. It was dead wrong.
And that model was called Black-Scholes. This was a huge deal, a Nobel Prize-winning idea that basically became the foundation for modern finance. But it was all built on this one critical assumption, that volatility, which, let's be honest, is just a fancy way of saying how much a price swings around, is constant. It assumed the risk of a massive price crash was the exact same as a massive price rally, and that this risk would never, ever change.
So, if you follow that logic, right? According to this perfect academic theory, if you were to plot the implied risk for an option across all the different price points, you should get a perfectly flat, boring horizontal line.
But that's the multi-trillion-dollar question, isn't it? What actually happens when you take this pristine little theory out of the classroom and throw it into the chaos of the real market? Well, you get this. And the most important thing to see here is that the line isn't flat. It's not even close. For stocks, you get this lopsided smirk that slopes down. For currencies, it's a more symmetrical smile. In both cases, the market is basically screaming at us that risk is absolutely not constant. It's telling us that the chance of some wild, extreme event is way, way higher than those old models ever gave it credit for. So why? What caused this massive break from the theory? Well, the answer can be traced back to a single, terrifying day in market history. A day that completely rewired how every single investor thinks about risk. You know, before 1987, things were pretty chill. The markets were kind of complacent, the Black-Scholes model seemed to work just fine, and yeah, volatility curves were mostly flat. And then came October 19th, 1987, a day we now know as Black Monday. This right here, this is the number that changed everything. On that one day, the Dow Jones Industrial Average dropped by 22.6% in a single day. This wasn't just some market dip. It was an earthquake that proved the old models weren't just wrong, they were dangerously wrong. That crash taught traders two really brutal lessons. First, that fat tails are a very real thing. That's just a stats term, but what it means is that those supposedly impossible, once-in-a-lifetime catastrophic events, yeah, they happen a lot more often than the models think. And second, panic has a direction. In the stock market, real gut-wrenching fear sends prices spiraling down, not. And this left a permanent psychological scar on the market, a condition you could almost call crashophobia. It's this deep, persistent fear of another Black Monday, and it makes investors constantly willing to pay extra for insurance against a total market collapse. And that insurance, it comes in the form of put options. But here's where it gets interesting. This crashophobia, this fear, it doesn't look the same in every market. The actual shape of fear changes depending on what you're looking at. And this slide just lays it out perfectly. In the stock market, you get the smirk. It's a one-sided fear, driven almost entirely by the terror of a sudden crash. But in the Forex market, the currency market, you get a symmetrical smile. And why is that? Well, think about it. A crash for the euro is at the exact same moment a massive rally for the US dollar. The risk goes both ways. So let's zoom in on that equity smirk. It's mostly driven by the big guys, pension funds, mutual funds, who are always long the market. They have to protect their huge portfolios, so they are constantly buying out-of-the-money puts as a form of insurance. All that relentless buying pressure pushes up the price and therefore the implied volatility of that downside protection, and boom, you get the smirk. Now, the Forex smile is a different beast entirely. There's no natural up or down when you're talking about a currency pair like the euro versus the dollar. A huge, unexpected move in either direction creates total chaos for international businesses and banks. So what do? They buy protection against big moves up and big moves down. That bids up the prices on both ends, the wings, and creates that classic U-shaped smile. Okay, so this is all really fascinating theory, but what does it actually mean for us? Why should you even care about the shape of this smile or smirk? Well, because it's not just some pattern on a chart. It's a massive trading opportunity. And this is a really key insight. The most sophisticated traders out there,
They aren't just betting on whether the S&P 500 will go up or down. No, no, no. They are making bets on the shape of fear itself. They are literally trading the skew, the smile, the whole volatility surface.
Let me give you a quick example. Let's say you think that crashophobia has gotten a little out of control and that equity Smirk is just way too steep. You could put on a trade called a risk reversal. You'd sell those expensive, fear-driven put options and then use that money to buy the cheaper, more hopeful call options. If you're right and the fear starts to calm down, the Smirk flattens out, and your trade makes money. You literally just profited from a change in the market's mood.
And look, for anyone who's actually managing money, this isn't just a cool opportunity. It is a critical, flashing red warning sign. The smile is mathematical proof that those so-called black swan events, those extreme crashes, are far more common than the standard models would have you believe. Any risk model that ignores the information baked into the smile is basically blind to the market's biggest fears, and it will catastrophically underestimate the real risks out there. I think this quote just nails it. The volatility smile isn't a bug, it's not a mistake. It is the rational, collective price tag that the entire market puts on one simple fact. The future is uncertain, and it does not follow a neat, tidy little formula from a textbook. So the next time you look at the market, I want you to think about this. Don't just look at the price. Look deeper. Because hidden inside the prices of all those options is this beautiful, complex, and, yeah, sometimes terrifying shape. A shape that tells you exactly what the market is truly afraid of.